Today we're going to talk about the biggest mistakes that I see in real estate. Hi, my name is Khleif, and I'm host of the Lifetime Cash Flow Through Real Estate Investing podcast. We've been blessed to be #1 in the real estate, business, and education section of iTunes for almost a year. I'm also author of How to Create Lifetime Cash Flow Through Multifamily Properties, 200-page book that I'm going to give you for free at the end of this video. So, the first mistake that I see people make when they're investing in any sort of real estate, and my specialty is multifamily properties, but this goes across every sector, is thinking that real estate is a get-rich-quick scheme. It is not a get-rich-quick scheme. If somebody tells you that it is, run, okay? Real estate is to become very wealthy over time, but not a get-rich-quick scheme. Now, the second big mistake I see people make is thinking they can just dabble in real estate. Anytime you dabble in anything, the stock market, real estate, even in business in general, you are going to get crushed. Now, if you take the time to learn this business, I tell my students, my coaching clients, you go on two paths when you're learning anything, including real estate. You have to do the book study. You read the books. You do the courses. That's one path. The second path is you have to get out there and mix it up. You have to look at deals. You have to meet people. You have to immerse yourself in the business. Don't dabble. Dabblers get crushed. The next mistake I see people make is buying in a market that they don't know well. Okay? Now, I suggest 4 markets to consider when you're first getting started in multifamily investing. First being your backyard, because obviously you know that well. Second choice would be somewhere that you've spent some time, somewhere maybe you grew up or went to school. The third choice would be somewhere you have family or friends or boots on the ground that can help you if you buy a property there. And the fourth market to initially consider, in my opinion, is somewhere you enjoy going or somewhere you want to retire. Now, once you select a market to consider, you have to do some market demographics, and it's very easy to do. You can do it on your laptop these days. We never had these options when I was first starting out in real estate, but you go to websites like bestplaces.net, census.gov, citydata.com, and you do some initial evaluation. You make sure you're not in a town that only has one employer. You make sure that the population, income, and employment is all growing. And you do some basic analysis of that area. But you must know the market. So if it's not your backyard, you need to learn that market. Very, very important. Don't make that mistake, my friend. All right, the next big mistake that I see people make is thinking that real estate is a sport you do by yourself. It's not. Real estate is a team sport, especially commercial multifamily real estate, okay? What's great about commercial real estate is when you're out there getting loans or finding investors to loan you money, they're looking at your whole team. So put a team together. Find the real estate attorney that you need. Find someone that's got the experience if you don't have it. Find someone that's got the income and net worth if you don't have it. Put a team together. Remember, my friend, 50% of something is a lot better than 100% of nothing. And so this is a team sport. Don't try to do it alone. I don't do it alone. Don't do it alone. Okay? Don't make that mistake. The next big mistake I see people make is they get impatient. And I'm the poster child for impatience. Don't do that. Get into real estate for the long game. You are playing real estate for a long time. It's not something you're going to get in and out of. So don't be impatient. Learn the business. Learn the area. Understand the terminology, the nuances of buying real estate, and stick with it for the long term, because I promise you it will pay off. I love this graphic, you know, being 2 feet from the diamonds and giving up. Don't give up. Keep going. Plow ahead. You'll be very glad you did. Okay, the next big mistake I see people make, you analytical ones, you know who you are, you get caught in analysis paralysis. And many, many people get stuck here. If you're an analytical person, of course, you love the courses, you love the books, you love studying this, and I get it, but you've got to learn to love getting out there and meeting people, getting out there and making relationships, meeting brokers, meeting lenders, meeting potential investors, partners, and private lenders. Get out there and meet people. Get out there and kick the tires on deals. Go look at deals. Go evaluate deals. Once you take down that first deal, all the fear will be gone. So push yourself, get past the analysis, and again, I promise you it'll be worth it. Now, on the flip side, those of you that are like me, that are the fire, ready, aim sort of people, that have made every mistake in the book, that would be me, every mistake in the book, you need to do a little study too, okay? So, there are negatives to both types of people. The outgoing ones like me are the ones that typically make all the mistakes. So don't be that either. Make sure you study, you do that. That's why I say 2 courses, your book study, and you're out there mixing it up, looking at deals and meeting people, okay? All right. The next mistake that I see people make is when they get a package on a property from a broker, from a seller, just always expecting those numbers to be accurate. And I hate to say it, but regularly they're not, okay? Because there are such huge exponential impact of the net operating income being higher or lower, because for those of you that understand multifamily a little bit, any increase in the net operating income, which is the gross income less the expenses, the net operating income, NOI, any increase in that, even slight, has a huge exponential effect on the value of a property. So, for example, if you've got a 100-unit property and you increase the rents $10 across the board in a normal environment, that's about a $400,000 increase in value. So it's not outside the realm of possibility for a seller to leave an expense off the expense statement. Because again, anything that impacts that net operating income could be income or expenses. So they leave an expense off, it's a huge impact on the value of the property. So the point here is you've got to do your own homework. You've got to go through those expenses. You've got to put reasonable amounts to those various expenses so that you don't make a mistake. Get some help. Make sure you understand how to do this. My book will help you a lot, and I'm going to talk about that in a minute, and it's free. So stick with me for another minute, but make sure you do that homework. Okay. The next big mistake, and this is a very common mistake, is someone will analyze a property and they won't calculate that the taxes are going to go up. When you buy a property, you're paying more money. The assessor is going to see that and they're going to raise the taxes. Okay, so very, very important that you always check that and find out what the taxes are going to go up to, and you use that in your calculations. It's a simple thing to do, but a lot of people forget to do it. Don't forget to do it. Okay, the next mistake this is a big one that I see people make a lot, is they go into a transaction or into a deal and they or their team don't have enough money, or they don't anticipate negative cash flow, they don't properly estimate the repairs, and they get into a bind. They get halfway through a project and they can't finish it because they didn't accurately estimate the repairs. So very, very important. You do this properly. You do your homework. You calculate what it's going to take to carry this property if the property is not cash flowing for a period of time, that you calculate properly what the expenses are going to be. So don't rush this. If you don't understand this, get help. Again, read my book, but maybe find a mentor, but get some help on this if you're not very, very familiar with these things, because this is where a lot of first-time investors really get tripped up and get into trouble. So I think this slide more than anything else is one you really need to pay attention to and be sure that you prepare for, okay? Now again, you can put a team together, you can bring in people with money, you can bring in people with experience to shore up any of your own deficiencies, because real estate's a team sport. So do that. Get the help, get the experience, get the money so that you don't make a simple mistake like this. All right. The next common problem I see is when you're looking at multifamily real estate, or any real estate in general, you'll typically get a rent roll. And maybe the rent roll shows 10 tenants and it's $10,000 a month in income, and you're like, yay, this thing looks fantastic. Well, that's not enough information. You've got to look at what the property is actually collecting in rents, because the rent roll may show 10 tenants at $10,000 a month, but they're actually collecting $7,000 a month, and that's called economic vacancy. So it's very, very important that you really get the actual financial numbers and you look at what the property is actually doing. You don't base it on the rent roll, you base it on reality, okay? There could be tenants that have moved out, tenants that aren't paying. So always pay attention to economic occupancy and make sure you determine what the economic vacancy is, meaning what's the property really doing, okay? All right, the next big mistake that I see people make, and I get emails from my listeners in my podcast, my clients, and they'll send me a deal. And they'll say, this deal sold 5 years ago for $2 million and I can get it for $800,000. And I say, I don't care. What's the cash flow? In fact, the subtitle of my book is The New Rules of Real Estate Investing. The new rules, my friend, are focus on the cash flow, not the value. Value is irrelevant, okay? First of all, we're heading into another contraction. So if you focus on value, you're going to get your butt kicked like I did in 2008. And I don't want that for you. So focus on cash flow. That's the only barometer you need to pay attention to if you're buying investment real estate. And if you're buying your own home, it doesn't matter. But if you're buying investment real estate, you have to focus on cash flow. Appreciation is a bonus, okay? Value is a bonus. You are focused on cash flow. All right. The next big mistake, in fact, I just got a call from somebody on this a couple of days ago, is misjudging market rent value, okay? When you're analyzing the market rents on a property, it's very easy to make a mistake, okay? And I just got a call from somebody. They literally lost out on an opportunity that had $1.5 million in upside potential. They could have bought it $1.5 million less than what it could go to based on the fact that they misjudged the market rents, okay? So here's what you have to do to make sure that the market rents are accurate. First of all, you need to use multiple sources for your information. So when you're checking out a property, you're going to go to apartments.com, Rentometer, rentbits.com, Zillow, Craigslist. But what's important is that you make sure you're checking apples to apples, okay? Not apples to oranges. So what I mean by that, let's say that you've got 2-bedroom units in the property that you're looking at, okay? You're not just going to look for other 2-bedroom units. You're going to look for 2-bedroom units that are the same size. They're the same approximate year built. They have the same amenities. Let's say washers and dryers in your units that you're looking at. You've got to make sure the ones you're looking at have that. You want to make sure that they treat utilities the same way. Okay, if one building pays water and electric and the other one doesn't, that's a huge swing. And remember my example about $10 increases in the net operating income, that includes rent. So if you misjudge the rent, it's a huge swing in the potential value. Again, very important that you get accurate. Now you also want to call brokers, you want to call property management companies to make sure that you have an accurate projection of what the market rents are for a property. I'm really hammering this home because, like I said, I just got a call from somebody that lost out on an incredible deal because they did this incorrectly. They misjudged what the rent's potential really was because they didn't compare apples to apples. So be careful with that. All right. The next really big mistake I see people make is not asking for seller financing. Now, when we do our marketing campaigns, and I teach this, I talk about this in my book, also in my courses, but when we do marketing, we always market to people that have owned the property for a number of years, ideally maybe 10 to 20 years. And the reason we do that is because they're ripe for seller financing, but you have to ask. You can't be afraid to ask. I mean, I interviewed a kid on my podcast, and I forgot his name now, but he was in Michigan, and he asked for seller financing, and he had a great relationship with a banker, and he literally bought $1 million property for $5,000 down because the bank allowed the seller to carry part of the down payment. I've purchased properties literally for nothing down because I built a relationship with a seller and they allowed us to carry it, and they didn't want a big down payment, they just wanted payments. But you have to ask, okay? And you have to become good at asking. And if you're dealing with sellers that have owned the property a long time, you have to be good at explaining to them that truly it's in their benefit to carry the note because they're going to cash flow better than if they put the money in the bank at 1% interest. So you want to be good at explaining it, but you have to ask for it, okay? Now, the next big mistake I see owners make, in fact, I just literally talked to somebody a couple of days ago that owned quite a bit of property in their own name. You never own investment property in your own name. When you're a landlord, I hate to say it, but we're in a very litigious society. And when you're a landlord, you're literally walking around with a bullseye on your back, okay? And there are lots of unscrupulous tenants and contractors and people out there that want to take advantage of you. You always own your properties in an LLC. Now, if you're buying commercial multifamily, here's what I suggest you do. Set up an LLC for each property, and then you have, ultimately, if you have multiple properties, you have an LLC that's like a holding company up and above your property-specific LLCs that holds the interests in these property-specific LLCs. Meaning, if you've got 5 properties that are decent size, 10 units or more, you're going to have 5 different LLCs, but then you'll have your own LLC that owns the interests in those 5 LLCs. Hopefully that makes sense. The bottom line is you've got to have your property, just your property has got to be in LLCs, even if you just own those LLCs in your own name, regardless. I might got a little too complex there, but the bottom line is you definitely want your properties in LLCs and ideally in separate LLCs. I mean, if you've just got duplexes, you could put a handful of those in an LLC, but if you go over 7 or 8 units, I would always have those in property-specific LLCs, okay? All right. The next and last really big mistake I see people make is they don't take their time choosing their contractors. They don't ask for referrals. They don't check references. They don't use agreements. Very important to use an agreement when you use a contractor for any size scope of job, that you agree on the timeline, you agree on the price, and you spread out the payments so that you never get ahead of that. If it's a brand new contract, you never get ahead of them, meaning you give them an advance that they could walk away with. So be very, very careful with contractors. Hopefully I've added some value on these mistakes. Now let me take a minute to tell you about my book, which is absolutely free, and it's 200 pages with no fluff. It's like a textbook for real estate investing, and it's absolutely free. You just click on the link below to get it. I mean, I go through how to pick the markets like I just told you about, and how to make sure a market's emerging and not contracting, how to find great deals, how to talk to brokers, I have broker scripts, how to talk to sellers, I have seller scripts, how to talk to bankers, I have banker scripts. It's all in the book. How to negotiate if you have to renegotiate, how to find the money for your deals, how to find the partners for your deals, how to develop an elevator pitch to find partners, how to do syndications, big chapter in there done by a syndication attorney for you to do syndications if you're going to go pull money in to buy big deals. How to perform due diligence. I have a due diligence checklist in the book so that you don't make any mistakes. How to manage your properties, and just, I mean, everything, soup to nuts, everything's in there. Just click on the link below, get a free copy, and if you like this video, please subscribe to my channel. Please comment below. We respond to our comments. If you've got any questions, leave us a question. We're happy to help you. Go kick butt, my friend. My name's Rod Khleif, and I am wishing you incredible passion and massive success in your business and in your life.